You've said the consumer is strong, continues to be strong. I think you said 10% up perhaps from what you saw in October. But how long can it last? You have some competitors saying by the middle of next year, they're going to run out of those balance sheets.
David, good to be with you again. So let's step back and talk about the different ways we talk about resiliency. First is, are the consumers spending? Are they doing things that drives the U.S. economy, as you well know? And so the spending for the third quarter was 10% higher than it was last year's third quarter. The spending for the first couple weeks in October is 10% higher than it was last October for the first 2 weeks. Now, what we told people was you're seeing it slow just a hair. So it was maybe 14, 15% early in the year, 12, and now 10, which is frankly what people are trying to do is get the spending down a little bit, get the inflationary pressures down and the drag of the interest rates, but it's still strong. And then so that's one way to think about it. Another way to think about the consumers, do they have money in their accounts to spend? And in the month of September, the account balances were flat or slightly over where they were in August. And that is multiples of where they were pre-pandemic, and they continue to hold their own. And you can see inside the cash flow in customers, not making any reflection on this is tough on certain customers, others, but even when customers have lower income levels, we can see them cash flowing positive still. Rent increases could slow that down, other things could happen, but the core thing is, as of the third quarter, they continue to cash flow and they continue to have more money in their accounts than they did before the pandemic by multiples. And then you go to their credit quality, and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit. And that's good news for America, but it also makes the Fed's jobs tougher because they're trying to slow down this American consumer, which is a very resilient thing.
But just to make sure I understand it, and obviously you can't promise what's going to happen next year. I'm not asking you to do that. But a lot of economists are saying the reason consumer is so strong right now is because the balance sheet were so strong coming out of the pandemic. At this point, you don't see those balance sheets really turning down as we get into next year.
We don't see it yet. And so if you look back to 2 quarters ago when we did the earnings call, people are like, oh, the consumer is getting knocked out of the game, they're spending their accounts. 6 months later, the money's still there. So I think people are over-anticipating the future. We, as our projections, Canada Balance Plot, and the team in our research group, which is one of the best in the world, has the third quarter positive, the fourth quarter negative, the first quarter negative, the second quarter of 23 negative, and the third quarter of 23 negative, albeit at like a 1 to 1.5% GDP annualized growth rate, negative growth rate. So we are predicting a shallow economy. That's our core assumptions. And embedded in that, if you look at how we set our reserves, we have the assumption that we're going to have 5.5% unemployment. I'm not sure it's going to happen, especially this quarter. We have it at 5%, but that's the conservatives when we build our balance sheet from an operating basis. But if you look at the consumers, there's not the signs that we see in our numbers or other people's numbers, quite frankly. It says they're slowing down yet or they're in stress yet, and that will have to be part of what happens in order for there to be a deep recession, because if the consumers have money in this big consumer-driven economy, that's what keeps America strong.
Brian, you've always taken great pride in the Bank of America research unit and how good they are. Let's assume their numbers are exactly right. It could be better, could be worse, exactly right. 3 down quarters, 5.5% unemployment. What does that do for your loan loss provisions? What kind of provisions do you have to make for that?
Well, inherently, we're always discounting the future because the way the CECL rules work, so-called, you look out for the life of loans. So you build reserves, and we built $400 million or so this quarter, which is building that scenario, which is 60% to the base case, which is the average of blue chip economist, and 40% to an adverse case. And when you blend that together, it implies those adverse cases have high inflation and have high unemployment in them. And you blend it together, the core, what we did at the end of the third quarter, has 5% unemployment for the fourth quarter of 22, and more than like 5.5 for next year. So it's very conservatively built. So your provisions will go up against that backdrop. At one point, you'll start to see the other side of it emerge, and that's what sort of happened back in the pandemic. We put up a lot of reserves, and we took them back in once you saw that the impact of, because what the administration did and what Congress did and what the central banks did around the world, you actually mitigated the effects of the unemployment numbers. That won't happen in a standard recession, I would expect. But on the other hand, the consumers are going in much stronger shape than they did even in 2006-07, leading into the great financial crisis.
Brian, throughout your tenure, as far as I can tell, you've really embraced what you call responsible growth. We know what it's looked like in the last few years. What does responsible growth look like for Bank of America in the next 4 quarters? Just take 4 quarters.
Well, we continue to look for deposits to basically outgrow the industry, and the industry is predicted to go down to flat, and we will be in that range because, frankly, the monetary accommodation will be drawn. We look at loans to grow in the mid-single digits. They grew a little faster year over year. Then we slowed down a little bit because of some of the capital changes that occurred in the third quarter, which we've taken care of and put in the rearview mirror. So we sort of look at that. But the key about responsible growth is people forget it's not only the growth, it's also how we get there with our operational excellence platform, which allows us to drive expenses. The work we do in OpEx continues to fructify into further and further gains for us, so that we had 3 quarters in a row of flat expenses while the revenue kicked up, and that's where you see the margins kick in, and our efficiency ratio is down in low 60s and moving south from there. Those are good things, but that comes from hard work beyond just can we get growth. It's how we run this company, and the team's done a great job doing that.
So, Brian, again, you've prided yourself in really carefully blocking and tackling on the expense front, and you've gotten a lot of credit for that. What does that say about employment in the scenario that you're laying out? You could have cuts, but even apart from cuts, maybe through attrition, do you expect your payroll to diminish?
We don't expect the payroll to diminish, and we don't expect the headcount to move much. We're running the company today in 2022 at the same number of employees who ran the company in 2015, round numbers. What those employees do is change dramatically across. That's 7 years, David, so it's not a short time. And so we've redeployed those employees more towards generating good work for our customers and our clients and better experience for them, and taking them out of work that we engineer out of the system through the digitization and work we do by our customers and by ourselves. And we'd expect that to continue. Sort of relatively flat head count, but there's a massive change that goes on underneath that. So we added 1,000 people in our investment banking team over the last 12, 18 months, and we're going to keep those teammates and keep driving because we're number 3 market share, and we think we can get more if we keep deploying people out to go see those great clients we have. So we don't need to drop expenses. We're running basically at a level that our company feels strong at and good profit margins, and you have natural adjustments that go on when markets go up and down based on bonuses and stuff, but that's not the core case. The 213,000 or so teammates we have here are doing a great job, and our job is to keep them employed. Can we manage the headcount up or down? Sure. Headcount, by the attrition that goes on, you can always manage it down, but right now we're kind of flat. We expect to maintain flat. Now remember, we had to hire like 5,000, 6,000, 7,000 people this past quarter, third quarter 22, to keep that headcount basically up a little bit. So our teammates who leave us go to great jobs other places. We've trained them well. We'd rather for them to stay, and our attrition's coming down, but when they don't, that doesn't mean they're going to sit on the bench. They're actually going out there to work for someone else, and we bring more teammates in and do a great job with them.
Brian, I know one of the things you've paid a lot of attention to, you and your team, I should say, is value at risk. Tell us about trading value at risk. How are you going to be managing that through, even under your projections of a shallow recession? It's still going to be a bumpy ride.
Well, let's just start with the backdrop. Jimmy DeMar and the team did a great job this quarter and had the strongest third quarter in 2022 they've had since 2010 in trading. And so fixed income rose. The investments we made in the balance sheet and the talent in that business over the last 3 or 4 years bared fruit, starting under Tom Montag and now under Jimmy. The second thing is, the way they manage risk, they didn't have a trading loss day the whole quarter in a very volatile quarter, and that's how they manage risk. Our job is to move the risk from the market to the client, and to the client back to the market, and we're in a moving game, not the storage game. And value at risk has gone up because of the volatility in the calculations, but it's still way below probably 25% of where it was at the volatile times back coming out of the financial crisis. And the balance sheet's strong, and Jimmy and the team has done a good job. We'll continue to manage that. We continue to watch how much risk they put on. They make judgments every day, but they have risk-weighted assets and VAR limits, and the VAR limits by desk, and they manage all that for us. But it doesn't constrain their ability to do good business. But you got to start from the basic principle. We're not in this business to pull a lot of that risk in the markets business on our balance sheet. Our job is to move it through the system. Talk about a couple of specific areas. One of them, leveraged loans. There seems to be some stress in the leveraged loan area right now. How do you assess the risk in that business? Are you going to be retrenching? Well, there's a natural retrenching that went on because the market stopped. When the spreads went out and the cost of debt became so expensive, the deals are harder to get done. So that's what happened. So that stopped, I don't know, 3 or 4 months ago, probably, maybe even 6. And so what's happened now is we're working through the pipeline existed then. Those marks went through the P&L. We mark it every week based on the analytics going through every deal. It was less this quarter than the quarter before, and it's through the system. To restart that market, you got to get the stability, and you got to get the pricing stability, and you got to get the lending capacity stability, i.e. how many debt turns you can do and things like that, and then that market can restart. And it's not ready. It's still bouncing around too much for that. We got to let that play through. But in the end of the day, we look at those credits and make sure we understand the credit risk. And sometimes what's happening now is the price is blowing out. Therefore, there's marks in them more than there is an underlying credit. Some of those deals are structured very well, and that's how we drive responsible growth. But on the other hand, the restart of that market is going to take a little bit till there's some stability in the spreads and pricing and the economy and the risk around the economy, because that market really is driven by people's perceptions of near-term risk.
Brian, as you know well, there's a lot of concern, given the stress domestically and particularly internationally, on whether there could be market disruptions. In fact, one of the things that I've read a lot about is a real reduction in the liquidity in the U.S. Treasury market. Are you seeing that, and what are the risks that poses?
We assume market disruption. So what happened in the UK a week or so ago, we just assume that's going to happen. And the challenge is to be balanced and have your risk managed well and have your risk kept and not lean the company and lean the book too far either way, because then you get caught. And so we expect those market disruptions. There are issues because of the rules that were put upon our peer institutions and our institution that have constrained liquidity, and they look at those rules and they've waived those rules in times of stress. I think they need to look more carefully at them. They know that to make sure that things like treasuries have no risk and just that market can stay open and wide and deep every day. And it bumps around every once in a while because of people's views of really spreads and rates. It has nothing to do with the credit risk. And I think we believe that some of that stuff shouldn't be counted the way it is, so we can be more active in intermediating those markets. But if these are the rules, we got to play by them.
Well, that's exactly what I want to ask about. Are there some regulatory things that we done that could alleviate that? There's the Basel III, as I understand, is coming up. There may be increases reserves there. On the other hand, there's also the supplemental leverage ratio that was suspended for the pandemic, then brought back in. Should they be considering doing something to sort of increase the liquidity in treasuries?
I think the SLR relief at a time of stress when they needed the banks to be strong sort of proves the point, is that they may not have it calibrated, but they're looking at all that. In the end of the day, our supplementary leverage ratio for our company is very strong, very far over the minimums, and it's tens of billions of dollars of capital in excess of what's required. So we're there to do it. It's just that you want that market to be. That is the market the world benchmarks off. We got to keep it open and deep and trading and liquid, because that is the market where everything else plays off. When there's disruptions in that market, it reverberates throughout the world, and that's what we don't need to do. As we raise rates for causing reverberations in the world, we don't need a liquidity reverberation on top of that. So we advocate as an industry a lot that they ought to look at that and think about whether there's any real risk there, and let us intermediate a little more fully.
Brian, you referred to what happened with the Bank of England and the British government, for that matter, involving those pension plans and long-term gilts, as I understand it. And you said we have to expect something like that could happen. My understanding is often it happens in the dark corners that we don't know as much about, and often it's a matter of leverage. Where do we have the most leverage in the system right now, and particularly in darker places?
Well, as we've made clear over the last several years, the banking industry, continues to be well managed by the management of the company and the teammates that work for these companies, well regulated, capital levels up, liquidity and all these different rules managed in all the different ways looked at, active forceful stress testing done once a year by the Federal Reserve and multiple times during the year by the companies. And so you put all that together, it's a pretty strong framework. The problem is what's outside the system. And so if you look at some of the advocacy that we make as a group, as banks, is half of every lending asset class is now outside the system. So the amount of leverage can go on in the unregulated industries may or may not be consistent. Now, the good news is most of that's in what they call net asset value. In other words, that if the asset goes down, the amount they owe the investor goes down, so it kind of takes care of itself. It's not a deposit, which is fixed at $1 on the other side. But it's not always true, and some of that leverage can hurt. So I think if you look at the banking system where it's leverage credit, for years we've kept limitations on how much leverage and debt turns. The SNC process, the Shared National Credit process, the examinations by the regulators kind of keeps the banking system in line. Outside is the worries, and you saw the FSOC and others kind of think about that and talk about that. And we advocate that we need that because at the end of the day, it affects our system even if it's done outside it.
For our Bloomberg television and radio audiences worldwide, we are talking with the Bank of America Chair and CEO Brian Moynihan. Brian, tell me about your customers and how badly they're suffering from inflation as you talk to them, because you talk to a lot of them, not just the big guys, but the medium and the smaller guys. How badly are they hurting because of inflation?
Well, the inflation's one thing, but also the rate structure that was moved to countervail the inflation. So it doesn't take a perspicacious analyst to realize that when you raise rates, people are going to have a harder time borrowing and things. So if you look at the mortgage market, for example, the increase in mortgages has lowered the number of mortgages that are getting done. Our production, I think, was $8 billion this quarter versus $20-odd billion last year this time. So you start to see that impact. And what that really reflects is refinancing on one side, but also home purchases and the ability to qualify. So you're seeing that. You're seeing the impact start to come through the rental market to match the increases that landlords will feel in the debt financing to refinance their buildings and do their buildings, although they're locked in. And people have to remember that a lot of this debt is now locked in for long periods of time under prior rate structures, both at the consumer level. Half our mortgages are under 3 and 80% are under 4 or something like that. So that's locked in very strongly. But on the other hand, those rising rates have that impact, and the stress occurs, and ability to qualify for mortgage credit and auto credit. Those are the sort of fastest moving changes. And then the cards move a little bit, but not that much, frankly, in the grand scheme of things. But you see it sort of move through those areas. And then on the business side, as the base rates move up, so for LIBOR, et cetera, and BSBY and things like that, you see the spread put on top of that. That'll slow down activity because the cost of debt just becomes higher. That's how you slow down the economy. That is the expected outcome. That is what the Fed's trying to achieve, is bringing down the economy. And the question is, can it be landed right? But on the other hand, you're seeing exactly what you expect, which is the conservatism built in terms of inventories cost you more to carry. In terms of buying a building will cost you more to finance. On the business side, you're seeing that, and you're seeing line usage come down a little bit because people are using the cash a little more aggressively. Because if they can avoid borrowing, it saves. At this point, a couple hundred basis points over these spreads is a fairly sizable number.
Brian, one last one. Let's come back to the consumer where we started. You said that your anticipation for Bank of America is to grow deposits at better than the market. Does that say anything about savings rates for households across the country? Are you expecting those to remain solid or even pick up?
Well, as we look, we reached a record number of investors on our Merrill Edge platform, our sort of general platform, not Merrill and the private bank, which are in the wealth management business, the 3.4 million. We had, I think, 100,000 new accounts open this year or something like that, net new accounts this quarter, this year. You're seeing people continue to invest because people should be investing for the future. I just we have our employees in that have 50-year milestones, 55, 60, and 175 years working for the company today to celebrate them. And I was looking at the write-up of one of the teammates, and he started in the business, the Dow was at 500. So the idea is for people to be invested and invest over time, and there'll be ups and downs, but if you stay with this great American economy, these great American companies, you'll be fine. So our job is to help people invest in the future. The savings rate and how people spend, you'd expect spending to slow down a little bit. You saw that a little bit because people are going to be more conservative. The inflation makes the dollar they spend not go as far. Those are real issues, but that's the intended outcome of trying to slow down the economy with higher rates and deal with inflation to bring it back under control so real wage growth starts to happen. Those are the things the Fed's doing, but if you really think about it, our advice to our customers is, stay invested the right way, look for quality companies, and Andy and Katie and Chris Hayes in the world, but don't be afraid of any environment. And yeah, there might be more opportunities in treasuries now than there was a year ago, but that's life, and that ebbs and flows, but you got to keep saving your money and invest for your future.